can we make it till next Q4 with this overstocked inventory position?
If you get this wrong, you just wipe out all of your potential profit for a period or go negative.
I've seen a lot of brands screw up basing their whole holiday forecast on the success of something unproven.
The catastrophic is when you order way too much and don't have a way of liquidating that inventory.
Dylan, episode 17, I'm going to say Christmas in July, holidays in July.
I was thinking the same thing. It's time to talk about Christmas in Q4.
So it's actually, as of this recording, it's July 21st. Why the heck are we talking about the holidays? We thought it would be we were kind of like thinking about talking about some inventory planning strategy, and right now we have a ton of clients who are, especially the ones who have to purchase from overseas. Everyone is racing to get their POs in for holiday, I'd say over the next several weeks here. So I think it's really timely for us to talk about Q4/holiday planning strategies. I mean, we'll definitely talk about inventory, but like more generally planning. I'm just curious, man, like, so are you hearing on your end in the agency side of the world, are you starting to talk with any brands about holiday planning, sales expectations, promotional plans, anything like that?
100%. Yeah. I'd say like some brands, it's sometimes even as early as like May, June. I guess it depends on like lead times on what you're getting. But yeah, normally like July and August are when it picks up the most for us.
Okay. This is a little off script. I'm just curious. This question has popped into my head. Like, what would make for, from your perspective on the agency side of the house, what makes for some of the more complicated planning discussions or scenarios that get brought to you that where it's just like, man, this one is, it's not impossible to plan, but like this is hard?
The duo that generally makes it the hardest is like first time customer dominant brand and lofty goals. So I think that when you have low LTV and are very much first order profitable, dominant in terms of how you're driving the vast majority of your contribution margin, it's a lot harder to kind of de-risk some of your sales targets. So like, I'll zoom out for a second. Let's just make a scenario. Let's say it's a first time customer dominant brand, and I want to go and do $5 million in sales in Q4. In the event that my new customer efficiency is 10% worse than I expected, catastrophic, not good, and I have very little return customer revenue, and I generally run with 10% margins when it's all said and done, that can basically cause me to have to move units at break even, or maybe for this hypothetical, let's even assume a loss if I want to move through all those units. Now, the caveat to that is like, well, maybe you could not move through all those units, but depending on how you finance that inventory, you might, unfortunately have to, depending on your situation. On the flip side of the coin, let's say you're a high LTV brand, you could basically opt to run below target if you know that payback's on the other side. So that's just like an example of like one that you have like a high risk, highly volatile kind of forecast to go and do versus this other scenario where the other side is potentially good. And I'm kind of glossing over it, but I'm sure the hardest is when it's first time customer dominance and the target is like very, very lofty or risky. And I guess the third thing you could add to that is like, if you don't sell it in Q4, you may not sell it until May or June, or like.
I was literally just about to, I was like, whenever you were done, I was literally going to be like, and if the next time you can meaningfully move through inventory based on seasonality is 6-ish months plus, is like away. That's the one thing that make it even riskier. And I'll even go as far as to say is a lot of the new customer dominant brands that I have worked with lofty Q4 goals, oftentimes, let's just say that 6-ish months from the holidays is the next time there's seasonally a pickup in demand. And it's like spring-ish, summer-ish, right? Early summer, late spring. That pickup in demand is literally still a fairly small percentage of Q4's pickup in demand. And so really, if you have too much of an overstock position, you may be waiting a whole year for Q4 to come back around again. And that's one thing that I'm, after having gone through so many Black Friday, Cyber Mondays, or just Q4s over the years with specifically brands that are highly seasonal and new customer dominant, or basically no LTV over a 6-month period, I've started to realize that like we need to forecast, can we make it till next Q4 with this overstocked inventory position as like a worst case scenario? Because I think I have allowed myself to be fooled in my earlier years of ecom of like, oh, we'll just move this next spring and summer, right? And we've been able to make a dent, but not a big enough of a dent, right? And really, it's like, hey, can we make it until the following Q4? And like you mentioned, there's a lot of other factors that go into that. When is the debt due? If you use debt, several other things. I'm curious, what is, and I'll share my kind of thoughts on this because we have to do this all the time. When a brand comes to you with what feels to you like very lofty Q4 goals, how do you have that conversation? It's not an easy one. It's not easy for me. Like, how do you navigate that? What are some things that you help brands think through to kind of like peel away the layers of like the assumptions that are under the hood?
Yeah, I mean, I think that like in a way we kind of like half answer it because we often don't have like the full context of the balance sheet and how that risk is really realized. But the conversation we'll generally have is like, okay, let's just build or think about scenarios here. In the event that you kind of buy inventory for this lofty target and X, Y, or Z happens, which is less than we think in terms of efficiency, volume, whatever, what could that look like? And does that break your business? And that basically then often goes back and it's like, I'll take it to the finance team. And then I imagine they go and chat and figure out what's actually going to happen. But that's usually where I'd say I would go. I think that like you and I have probably just seen it so many times where people overorder inventory. And like, I think I often like veer towards like caution with this because I've just seen it. I've seen like so many like bad situations where you're overstocked, and being overstocked really, really can be painful. On the flip side of it though, there are some categories where you really can take like disproportionate risks in terms of like the ROI could be very large if you really like go heavy. I'll give you an example. Like a lot of like health-based CPG brands, September to February is like this magical window where with Labor Day and like cooler months coming, depending on what you're selling, you often see new customer efficiency start to tick up. You then have those customers ideally come back and purchase and or gift in the holidays. And then to top it off, usually January and February, especially January, is the best new customer ROAS time of year. So if you really
just like a gym, right? New Year's resolutions, right?
Yeah, exactly. So like brands like that, in my opinion, you can like underrate the risk a lot better because even if you don't sell it in November, as long as it's not perishable to in a short time window, you have January to kind of continue to move those units, and you have often really, really strong LTV. So you don't have these scenarios where like it might take you 24 months or 12 months or whatever to move it. You might have that get moved in 3-4 months. Like it's really about understanding the unique makeup of your business. Because I've seen people be like not aggressive enough with their POs. But you just want to make sure you right size the level of aggression to the reality and the unique risks of your business. And I think that like in a way, like the stories I can tell or times I can think of, even if you run out, like if you wish you could have bought more, that means you're probably still pretty happy. You sold out of what you were expecting to sell, so it's not like catastrophic. The catastrophic is when you order way too much and don't have a way of liquidating that inventory. So yeah, those are kind of my thoughts on like the upsides, downsides, how to think about it.
Well, okay, so you brought up several things that I actually have listed in my notes about like doing a proper risk assessment of your sales forecasts, right? And so you actually hit all of them. Like the first one is to do a proper proper assessment of like how your brand's unique makeup of either LTV or being new customer dominant, how that affects the risk or lack thereof. Seasonality, right? How long do you have to wait for strong demand to return after the holidays? And then you also brought up the third one, which is obsolescence and or perishability risk, right? And so like, honestly, if you assess those three things honestly, like for your business, you're going to already make a better risk adjusted decision than most. And quite frankly, the reason I put these three in my notes is because these are the three lessons that I've learned over the years, seeing it done wrong, right? And so like I didn't know these things when the first time I screwed this up, when I created the inventory plan for Q4 2018 at Guardian Bikes. Like, and I quickly learned about several of these, right? And I think I've told this story before, or bits of a story anonymously on this show before, about a consumer electronics brand that I was working with a couple of years ago as a fractional CFO that had super lofty goals. And they ended up ordering what we, in hindsight, found out was like a year and a half worth of inventory for Q4 2023. And the reason came out of that with like $4+ million of inventory on the balance sheet, a ton of cash tied up in that overstocked inventory position. And it took a good 14 months to right size it and get cash flow back into a healthier position. But we did talk about obsolescence risk. We talked about seasonality. We talked about how how new customer, dominant the brand was, and they lived to fight another day. It was still a rough ride, and we needed to use every bit of our cash flow modeling that we could, and also a lot of our relationships with lenders to refinance and restructure the debt stack so that it could ride with them through a 12 to 18 month period of right sizing inventory. But we definitely didn't place that bet not having thought through these things. And it didn't turn out the way that we wanted it to, but the brand is profitable to this day and a lot more cash flow positive because we did assess some of these things on the front end. So another thing that you and I have both touched on is the debt piece, right? This is super important. I think, I don't know, didn't we previously chat, like maybe a few episodes ago, I think it was episode 14, and we talked about like raising equity versus debt in certain situations. One thing that I mentioned is the bigger the risk of the bet you're placing, the more mindful you need to be of using debt. And you should generally use less, but if you use a lot, you should be very focused on the terms of the debt, right? Most specifically, the time horizon of the maturity. When is it due back to the lender? And the problem is the easiest forms of debt capital for e-com brands to procure quickly and with like little bits of effort, they're very short term in nature. They're due very soon. Like MCAs you're paying them back starting on day 1 or day 2, basically. So you're paying it back immediately. Even some of the other like non-MCA, like non-bank lenders like Settle and Flexport Capital, they can be in the right like situation, really great debt financing tools, but they're usually due in like 90 days. Very short-term debt, right? So again, the reason why I was saying like, hey, is the next increase in seasonal demand like 6 months away? Well, if your debt is due in 90 days, but you got to wait 180 days for the next summer or spring seasonal sales spike, you owe someone a whole bunch of money for an overstocked inventory position before you liquidate it. And so like, it's really, really, really important to think about that alongside seasonality, obsolescence, or perishability risk, and whether your brand is LTV heavy or new customer heavy.
Yeah, and just to kind of comment on that too, like to the time horizon thing, I'm probably going to get the numbers roughly wrong in my head, but I've seen instances that are similar to like, I have a couple $100K in profit that I could possibly lock in. but I'm going to almost wipe all of that off because I'm going to chase that MCA as like a brand operator because they don't have a choice. It's like they thought they were going to move X dollars of volume. They ended up doing, I don't know, 60, 70, 80% of that very efficiently. But in order to pay off that 90-day, 120-day loan or whatever, they basically had to push, even though it was a contribution margin negative. So like you can basically, if you get this wrong, run into situations where like you just wipe out all of your potential profit for a period or go negative. So it's very, very key to get the time horizons on these things right.
Okay, so a couple other things. I want to talk a little bit more about inventory in a second, but let's talk about the other side of the spectrum from being overstocked. I've also been in the middle of numerous holidays, and I'm sure you have as well, where well before the holiday season is over, we can already tell we're on a run rate to run out of stock, right?
Yeah.
From the marketing agency perspective, run through just kind of like your checklist or your best practices of like advice of like, hey, we know we're going to run out of stock. What should we consider doing on the marketing side?
Yeah, so usually it's maximized contribution margin per unit sold. So try to actually understand how many we think we're going to sell from return customers and work backwards from there to understand how much we should spend on ads. If it's starting to look like we're going to easily sell through some of these things, even from return customers, that's where we'd often say raise prices, which is sometimes counterproductive or counterintuitive to like the time of year. But there are scenarios where it could possibly make sense. The caveat to that, though, is that with new customer demand specifically, that can sometimes have a negative impact to ROAS and impact your average profit per site visitor to a point where raising prices is negative. So that starts getting into, is the traffic coming from your email and SMS list or your ads or both? And if you're going to play like the increased margin game by either reducing discounts, raising prices, etc., you might have a situation where you don't want to run as much paid traffic to that page. So those are some of the things we would sometimes think about whenever there's like finite supply on something. But oftentimes first things first is just like high level, like we don't want to like sell out from first time customers if we're going to be able to basically move through these units with return customers, which will traditionally have more profit per visitor. There's some exceptions to this if like ahead of profit, you care more about like compounding growth, and maybe you can make an argument to go for the first time customers just to get them in your funnel. I think it's pretty rare that that's an actual KPI. We've had conversations like that in the past before, but traditionally it just moves towards profitability per unit sold.
Okay, so a couple of things I want to comment on. And by the way, like I learned this from a very successful high LTV supplements brand that we work with. I was not smart enough to come up with this on my own. They taught me, hey, make sure this is if you're a high LTV brand with like a lot of subscriptions, hide your subscription inventory. So what do I mean for that?
Too. Yeah.
Hide it from Shopify or whatever platform you're selling on. Hide it from available inventory so that you stock out of everything. You stock out of everything for new purchases, non-subscription purchases, right? But you still are holding enough inventory to fulfill your subscriptions effectively over whatever your lead time is, right? You need to make sure that you are always fulfilling your subscriptions so that you're all of a sudden seeing a bunch of churn and your whole kind of like CAC to LTV payback formula just completely falls apart. And so this is actually something that I've realized more recently as we work with more and more, heavy subscription brands. Another thing that I've kind of like coined over the years, I call it splitting the difference between overstock risk and minimizing landed costs per unit. And let me explain what I mean by that. What is the whole reason, or what is a big reason why brands want to place really big orders for the holidays? There's two. One is fear of lost sales, but the second one is minimizing landed cost, right? Because if you have longer lead times, usually it's a brand buying from somewhere outside of the country that has to deal with ocean freight lead times, which are long, right? Why not just air freight everything with shorter lead times? Well, It's because that's going to increase your average landed cost per unit, right? So there's a way to split the difference between minimizing costs by placing a really big order with longer ocean lead times, and split the difference between like what you're trying to do to minimize landed cost, but then also not put yourself as big of an overstock risk if you're not hitting your forecast, as well as be able to react to this situation where you're going to run out of inventory if you end up under ordering it. So that's placing a big PO, putting it on the water at a lower landed cost to the tune of like a quantity that you can comfortably afford, but don't buy any more than that. Then if you're beating your forecast, start air freighting smaller orders, right? It's gonna increase your average landed costs. But as long as contribution margin dollars are still positive, even if let's just say it's $10 per order ocean freight, and it's only $1 per order, right? Air freight, that still is accretive to the bottom line. And if you can afford it cash flow wise, and you're gonna lose out on the sale anyways if you don't air freight it, you're better off making $1 per unit than just like giving up the sale altogether. But there's a couple keys here. You can't just do this out of nowhere. The key is to be talking with your suppliers about this early. So like the way that I did this at Guardian Bikes was like, this was a Q4, I don't know, this is maybe 2018, 2019. We placed a big order that we could float with our own cash flow and with the debt financing we had. But we were talking with our vendors all throughout August, September, October, right? About like, what do we need to do to be able to like air freight another 10,000 units or another 5,000 units? And as we were talking about this with them, what they were doing was saying, hey, you know what? If you want to do that, we need you to buy all the frames ahead of time, right? And so we forked out a little bit of cash to buy these enabling components that could allow them to do a quick production run and, you know, put them on an airplane, right? But the supplier coordination is key. You can't just call them up out of nowhere right before the holidays or in the midst of the holidays and say, I need you to ship this right now. It's about coordinating along the way. And it can still maximize contribution margin dollars. It can still generate incrementally positive contribution margin dollars, but decrease the risk of overstock. And if you get in a situation like what Dylan was talking about, where you're going to run out of stock, you might be able to ship some units in, albeit at a lower profit, but still a positive profit to capture some of this, basically beating your sales forecast. So that's just this takes work and constant communication with your suppliers, but it is a tactic that you can use that I've seen work successfully for brands at times.
Yeah, me too. I've seen that done before, and I think it's a great strategy. I'll just add that when you're doing it for extra return customer sales, the probability of it being like incrementally profitable is likely to be very high because you probably have very little associated advertising and marketing costs to actually facilitate those sales. For the new customer piece, to your point, you already called this out, but like making sure that even with the increased costs, the incremental orders with the current ROAS or expected ROAS for the incremental volume is still ideally positive. And then there's just also different nuances for what you're buying, like smaller, lighter things. The difference in price between air and boat may not be as bad as you're saying like bikes. I'm thinking like that must have been expensive, but
no, that bikes are a lot harder to do it. Where I see this be more successful, small consumer electronics, apparel, right? Like, but even the right apparel, like there was a brand we're working with that was armored apparel. That was really, really hard because it's heavy.
That sounds
right.
Yeah.
Right. Great. And like a lot different than like, selling socks or, t-shirts or something like that. So you definitely need to know your costs. And this is definitely coordinated effort between your finance team, your marketing team, and your operations team. So like you do need to be highly coordinated, but if you have a really solid cross-functional communication, and like Dylan said, you really understand the expected costs, it can be a way to reduce risk, but still generate incrementally more profitability. Holiday planning is one of the hardest things to do from a planning perspective every single year. It's very hard. You're growing. And even if you have a track record of growing, you never know for sure what to expect, right? And what I have kind of found, and I hate buzzwords, but I've just found that it's really important to ask yourself, how can you 80-20 this? You're not going to nail the planning across your whole SKU catalog. And quite frankly, the more and more I help brands scale, the more and more I think you shouldn't ever waste your time trying to nail everything. The 80-20 is what it comes down to. And so it's hey, focus on not stocking out on your proven best sellers, right? And reduce risk by going smaller on new or newer unproven SKUs. The holiday, it's very tempting. It's really tempting to launch something brand new during the holidays, right? But the more and more that I do this, I tell brands dude, I just really have rarely ever seen that go well. Let's double down on what has a proven track record, right? And let's find a different time of year to test newer stuff. But I've screwed up personally and seen a lot of brands screw up basing their whole holiday forecast or basing a lot of their holiday forecast on the success of something unproven. And that is a highly risky combination that's quite frankly pretty akin to rolling the dice at the craps table, in my opinion. Do you agree with that, Dylan?
Yeah, I agree 100%. I think that of the examples that I can think of when over ordering has happened to the worst degree in terms of relation to them, the preceding amount of time it would take to sell through all the units, it's been on new or newer products that don't have proven Q4 sales. I'd even go to another level and say, let's say you validated a product in June and you think, or May or whatever, you think that fully validates your level of aggression for Q4, it's still not as validated as the product or the category that you sold last Q4, that you just know what to expect in terms of the seasonal trends for that product with that specific offer. It's not saying launching a product in half one of the year and then betting on it in half two of the year is a lot better than launching a product on November 15th and saying I'm going for it. That data is still valuable, but if I'm thinking about how aggressive I'm willing to be, that would still impact it. I don't have the data for how it behaved in Q4, and the more data you have, the better. And obviously, you can also have opportunity cost of waiting in forever or waiting a whole year to get that data for a really aggressive Q4 bet. But I think that should still be taken into account.
Totally. Okay, you mentioned offer, and that makes me think about holiday offer / holiday promotion, just best practices. What are some of the key pieces of advice that you have for brands when they're starting to think about how to structure their holiday offer or their promotional campaign?
Yeah. So I think it should probably be the best offer of the year for that period specifically. I think it really depends brand to brand. I really like up to offers because I think it gives you flexibility to kind of adjust and re-merchandise your site based off of what's selling and what's moving. But I say generally speaking, best offer of the year, make sure that it still makes sense on first-time customer acquisition. We've audited accounts or started working with brands that have ran offers where the discount for that period is so aggressive that it becomes basically impossible to make more profit dollars than you would in, say, a normal month. So to make sure that the margin still makes sense. Or if you're going to truly make it so crazy that you have some valid reason to do it, make sure you re-underwrite your expectations for first-time customer sell-through and ROAS. And it's basically just a moment to extract value out of return customer sales, but I would still be hesitant of that. So making sure A, the margins make sense, B, it's the best offer of the year, and then ideally it's also been tested before. So best case scenario, you've run it for another Black Friday, but I'd say the next best thing is probably testing it for Labor Day, which for a lot of brands is one of the other key moments of the year. Going into BFCM with an unproven offer is incredibly risky. And if you are doing that, I would probably lean towards extreme caution on the PO sizes I'm making, because I just think it's really hard to forecast an offer's performance you've never tested before. So those are some of the things that come to mind. I think there's another bucket of like, well, how long should my Black Friday sale be? And how long do I run that offer for? And I think that's like an imperfect game. I'm generally a fan of running the same offer, not for every brand, but for a lot of brands, from mid-November through until the shipping cutoff in December. But for your email list, that you may have to throw in some interesting changes. Maybe it's low SKU count, low MOQ drops of new products to spice it up. Maybe you're adding in things for email and SMS, the list specifically. But for first-time customers, I'm generally a fan of having the offer be pretty consistent for the majority of the holiday period. The counter to that is like you're just spreading out the demand across more days. But in our experience, while that is maybe true for email and SMS, the longer sale period for ads just gives more runway and puts less risk on fewer amounts of days and gives you more time to optimize.
Okay, so what do you, I just got to ask you this, like, what do you really not like in terms of like offer or promotional tactics that you see people out there try or suggest? Like, what do you have a pet peeve of like, no, I really don't think we should structure it in that way?
I just really don't like site-wide high discounts, like 30% off site-wide, 40% off site-wide. There are so few brands that have the margin profiles to actually like win with that as your offer. And I think if you're going to go into the sale with that as your offer, you're basically opting for, this is going to be driven mainly by return customers, and I'm probably going to run this sale as a shorter sale. And on the new customer side, if I'm running like target ROAS bidding or cost per result bidding or just lowest cost bidding, I'm like setting a different KPI for the new margin profile that discount has. But I also am just cognizant of the fact that even if you set those targets, a lot of the sales that occur for new customers on that moment are people who were also in market beforehand. And I just get super skeptical of the incrementality of like that discount for new customers. Again, I'm not saying you can't run a 20% off site wide or a 30% off site wide. The math can still make sense. But once you start getting into like 30, 40, 50% off, there's just so many brands that just cannot stomach that after CAC. And I don't think it's that incremental. So generally, I'm a fan more so of like buy more, save mores, get buy X, get Y's, up to X% off, where you can still make it a unique and strong offer. But I just think a lot of brands just over discount on Black Friday. And they should actually, in that case, if they do that, spend less on ads, get the profits from retention and people who are in market, and just take it as a profit generation moment, not a huge scale moment, which is probably not what I would suggest. But if you're going to do that, you could do that. What I'd rather see is an offer that is economically viable on ads, prolong the sale moment, and then find little opportunities to make the email and SMS lists engaged during that prolonged sale. Because let's just say your offer is up to 50% off and that crushes on ads. How many times in a month-long period from November 15 to December 15 can you just keep on saying up to 50% off, up to 50? Your list is probably going to get bored. So maybe you have to have some email and SMS exclusives. Maybe there's like certain moments throughout the sale where certain categories get a discount boost, where there's a bigger offer for this, or a buy more, save more. Maybe you're doing product drops during that time. I think that the offer almost has to be a little bit different for both ads and email and SMS. So yeah.
I think, to add to that, or I'll just echo, and I think we talked about this on one of our other recent episodes, of just like, there's a difference between a discount that like really feels like it tarnishes the value and one that feels very connected to the value, right? So like, buy more, save more. I really, really like from the standpoint that it's like, this is an exchange of value between the two of us, right? Like, I'm going to give you more value and then you're going to give me some more value, right? And so, and then it's, it also makes everything a lot more economically viable, generally speaking, on the unit economics or the order level unit economics. And so, I think those are all really, really, really helpful things for brands to think through. And I got to be honest with you, like there's a few brands that I've been a fractional CFO for who I've seen do like 30-40% off for like the whole month of November. And it was wildly unprofitable. Like, and even when I saw the marketing efficiency boost was like, they had stronger marketing efficiency boosts on less aggressive promotions earlier in the year. It didn't even impact marketing efficiency in a positive manner. And it was just like, it was totally like a losing endeavor. And it was a bummer, but they have since switched to like buy more, save more. It's been much more economically viable. And I've even seen the marketing efficiency turn out to be a whole lot better as well. On top of the fact that like just the gross margins per order are a lot better. So
yeah, I'll just throw out there one more thing. And again, every brand is different. I think mid-November to mid-December is like the key period where you want to be competitive with your offer. And I'm a fan of keeping the strongest offer running for that period. But we also see brands have a lot of success in early November if they want to launch it sooner. But I've seen brands crush their Black Friday sale 45 days long.
For sure. So buy.
Yeah, I just think a lot of people will like say like that's too long, and like at the end of the day, like maybe on return customers, yes, but for first time customers, like
yeah,
I've had instances where like a year prior, a brand started their Black Friday sale on November 1st, and then it's November 5th the next year, and they're not happy with the year-over-year comps because the first 5 days of November the year prior they had BFCM, and then day 6 they turn on the offer. New customer contribution margin just pops. It works all of a sudden, and then you're off to the races. And I think you can get into your point, like these situations where you don't want to be the always on sale brand. But during that time of the year, I think people just expect it. I totally think it's that big of a deal to have that prolonged offer. There's probably some exceptions, but for most brands, I just don't think it matters.
No, I think the structure of the offer is the most important thing. Like I think if you structure the wrong offer over that same time horizon, it can be a massive loser for you at brand perception wise and P&L wise. But if you have the right offer structure over the same exact time horizon, it changes everything. So, well, I think this is a good one, man. Any final thoughts on your end about holiday planning?
Yeah, I think you said it best earlier in the pod. Like, are you LTV versus new customer dominance? How does that impact your PO sizing, the seasonality, the obsolescence? Like I never kind of like personally like summarize it in those 3 things. I think if you just do those 3 things, you're probably going to be in like a pretty good position compared to everyone else. I think I couldn't have said it better.
And I think my final thoughts are just like alongside that, just really think about how risky your decision is, right? That's what this all comes down to. Assess the risk. And usually when you assess the risk, you have to take your planning, you have to segment it down a little bit, whether you're talking about SKUs or you're talking about some of these other like segments of risk. Like just do a little bit of thinking at a little bit more of a granular level about like how risky is this decision, and then size your purchase order in alignment with your risk assessment. So I think that's it, man. Hopefully this is helpful for everyone listening out there, and I'm pulling for you for a strong Q4 for everyone listening.
Yeah, let's go BFCM holiday. Let's go.
That's a wrap, a holiday wrap. Just kidding.